So, if you think about venture capital today, it's an industry that is extremely hot. Think Facebook, Dropbox, Angry Birds. That just the lights went out here. I hope you can still see me. Think about the Dropbox, Angry Bird, everything. So it's really hot. Just the other day, Instagram got bought by Facebook, and huge valuations. It's very interesting for a lot of people. What's driving all of that? If you follow a little bit what's going on technology-wise and in the marketplace, you know that Apple iTunes, the app economy, it's huge. It's getting bigger and bigger. You see 500,000 jobs created there, and at the same time, you also see startup costs for new businesses going down significantly. So I just talked to a venture capitalist the other day who told me that he wanted to set up a web shop, basically a factory outlet, roughly 10, 12 years ago, and it would have cost him, I think it was $15 million just to open the store and just to get the programming done. And if you think about it, what it costs you today, it's maybe an annual fee of $15,000 or so. So costs have gone down significantly. Basically, anyone could open a web store. Anyone could program an app, program an Angry Birds game, and get it out into the market and try his luck. And the same is actually valid for supply chain innovation. So if you have a great product idea, you could find some third-party producer to actually manufacture your product. And of course, this is creating huge opportunities for both entrepreneurs and also venture capitalists, because even though it has become much cheaper to initially start a company, you might still need the capital to bring your product to market, to fund entering a new market, and also the marketing, of course, is still costly. And for venture capital funds, this has mean that they have come across a lot of opportunities over the past few years. They have made great investments, some of them, and the interest has grown as well for investors to actually get the funds invested in venture capital, and also for the funds, then of course this additional capital has to be employed. They need more people to do all the screening of the deals. They want to be present in new markets and are growing. So this is actually opening for a lot of new opportunities if you're interested in the industry. And bottom line is, it's huge rewards for the most successful VCs, and still it's a lot of risk as well. Only very few companies really become very successful. There are a lot of companies that never make it beyond the startup stage, and a lot might be semi-successful. How can you categorize the funds? Basically, I would say there is a categorization that you could do by the investment focus of the companies. It could be an industry focus. So you would have companies that are focused on biotechnology, on internet, or even social media within internet. You could say that they are even more specialized. You could also categorize a fund by the stage they're investing in. Angel investors are mostly private individuals, could be entrepreneurs that have exited a company or several companies before, that are interested in some kind of technology, that have an angle in some industry, and that want to support also entrepreneurs that are having fun, sitting on the board of companies, helping young entrepreneurs to succeed. Seed funds, basically funds that today are being squeezed because you see those angel investors having a lot of resources and funding startups with a lot of capital, and so the seed rounds are sometimes not necessary anymore. This has also to do, as I said earlier, with the trend to be able for companies to be able to actually launch a product, launch an idea without too much capital. So then the early stage growth capital funds come into play, and they still have a role as the companies then, once they have established their business and have proven that their concept works, they actually get involved and then they fund the further growth of the company. In the US, there has also been a focus on different geographic focuses. So you would have typical West Coast funds that were based in Silicon Valley, like Kleiner Perkins, Excel, Sequoia, etc. Or on the East Coast, funds that were based or still are based, of course, and coming out of Boston and New York City. But this is getting less and less of a focus as all of these funds try to be present in all markets and try to attract the greatest deals, of course. Even some technology companies have their own funds. So Intel would have a fund, Sony, Google, other companies as well. And the main reason actually is to attract talent, to have access to new ideas, and to be present also in the minds of entrepreneurs that these guys are around and are willing to invest and might be there as an exit opportunity.